Tom Lee just made a bold call. Again, he's predicting a massive rally in the stock market. And according to him, the market's about to shock everyone. That's right, Fundstrat's Tom Lee, one of Wall Street's most closely watched analysts, went on CNBC's Closing Bell and said flat out, "There's too much cash on the sidelines, too many investors are still bearish, and that's exactly why we could be on the verge of a huge move up in equities." He believes most investors are still too skeptical, and that this wall of worry is setting the stage for something big. So in today's video I'm going to show you the full clip of what Tom Lee had to say, and trust me, it's worth hearing directly from him. Then right after that, I'll break it all down for you with my own take, what stood out, what I agree or disagree with, and most importantly, what it means for your portfolio right now. And at the end of the video, I'll also share one stock you should be watching closely right now, one that could benefit massively if Tom Lee's rally plays out. If you only have time to watch one video today, make sure it's this one, and watch it all the way to the end. Go ahead and hit the like button if you find value in videos like this. Let's try to hit 1,000 likes on this one. Share it with your fellow investors, drop your thoughts in the comments, and make sure you're subscribed to the channel so you don't miss the next major market update. Alright, let's jump into it. Here's what Tom Lee had to say.
Welcome back. Get ready for a melt-up rally. That is what our next guest is calling for in the months ahead. He is Tom Lee. He is Fundstrat's co-founder and the head of research, also a CNBC contributor. And as you see, he's here at Post 9. Nice to have you.
Great to see you,
Just
Scott.
saw Dietrich on. He's bullish. And you are too, but you say too many people are not.
Yeah, you'd think that with the S&P doing well this week and a great May, investors are bullish. They are not. You know, in our calls and Zooms with portfolio managers, many are still cautious because they see tariff risks ahead and they don't have tariff resolution in hand and they can't get bullish. I think the feedback we get from a lot of folks is they think stocks shouldn't be rising. So I would say, given the amount of cash on the sidelines, the fact that short interest is going up, and we have a quiet week and markets are rallying, I think the risk is now of a substantial leg up rally from here.
What role do tariffs play in all of the way you're thinking about the market?
Well, tariffs matter. Remember, before February, before Trump sort of talked about this, the base case for many was a 15% tariff. Let's say that we're going to end up at a 10%. That's 10% on 15%, which is imports, which is about a 1% GDP effect. That's not that different than oil going from 40 to 80, and we wouldn't say $80 oil breaks the economy anymore. So I think tariffs aren't, we have to adjust to it, but it's not the thing that takes us to 4,000 S&P anymore.
Now, what if there's a renewed and more protracted, if not dug-in fight over the tax bill? What if Musk's post on social media earlier is enough to get some lawmakers in a very thin margin Washington to rethink their positions based on his political donations or lack of support in the future? Is that a real concern in any way?
Well, this is what's going to be set up as what I'd call event risk. And it's an event risk similar to a government shutdown or an auto plant shutdown, something that affects the economy for a specific period of time. But again, those have not been things to turn structurally bearish. They may be tactical risks, but again, they've always been buy the dip opportunities.
So if, for argument's sake, the tax bill ends up not as big as the price tag is on it now, would that be a positive taken by the market? Maybe the bond market would feel pretty good about that, wouldn't it?
Yeah, I mean, Scott, it's kind of hard to say because I could see it being if bonds rally, that's good for equities. But if this tax bill leads to more spending, even if yields rise, markets are going to focus on the earnings effect. So I'm just going to say it could go either way. I mean, it could be bad or it could be good.
When you hear Jamie Dimon talk about there will be cracks in the bond market, do you just brush that off as that, I would expect someone in Jamie's position to be talking about the risks that are in the system? Or do you sit back and say, well, maybe that first little scream from the bond market was before there's a full-on tantrum, which wouldn't be good for equities in any way?
Well, JP Morgan has a dashboard to the U.S. economy because they see consumer credit. They see it real time. We know consumer credit delinquencies are rising and auto loan delinquencies are rising. But is that going to spill over into the broader credit market to create a credit event? The one market we watch is high yield. High yield spreads have actually managed to hold on to most of the rally gains, and they've retraced 70% of the widening. That that's a market that says the economy actually is starting to strengthen.
So you don't put that much cred into bigger worries about the bond market having an issue anytime soon. And even for accuracy's sake, I mean, it's not like he said we're going to have this issue tomorrow. I don't know if it's 6 weeks, 6 months, 6 years. I'm paraphrasing, but that's generally what he said.
Yeah, I mean, I think Jamie's flagging that there are parts of the economy that are weak, including housing. I mean, housing is deteriorating very quickly, but that's also going to deliver a pretty big deflationary pulse. That was 75% of the rise in inflation since 2019 is housing and auto services. So if housing is turning down on price because there's supply, I would argue that's a structural decline in inflation. The Fed would actually have to be quite dovish in the next 12 months. That's bullish.
This video is sponsored by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks, but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. So, let's start from the top. Tom Lee walks into this interview with a clear and surprising message. While the S&P is climbing and showing strong weekly performance, most institutional investors are still not buying into this rally. According to Tom, many portfolio managers remain hesitant, largely due to uncertainty around tariffs and broader macroeconomic risks. They're sitting on cash, they're increasing short positions, and despite the market's quiet strength, meaning no major catalysts, no wild headlines, the indexes are still climbing. Now here's where Tom's insight becomes incredibly valuable. He sees this skepticism not as a bearish signal but actually as the fuel for the next leg higher. Think about that. When there's a ton of cash sitting on the sidelines and short interest is elevated, any positive movement in the market can lead to rapid buying. Why? Because managers get caught flat-footed. They're underexposed and need to chase performance. This is what he calls the setup for a melt-up rally, a sudden sharp move higher that catches most people by surprise. Then he moves to the topic of tariffs. Now Tom acknowledges that tariffs do matter, but he puts their potential economic impact into context. He notes that even if we landed at a 10% tariff rate, that would only shave off about 1% from GDP. In his words, that's roughly the same effect as oil prices jumping from $40 to $80. It's an adjustment, not a collapse. The takeaway here is simple. Tariffs may slow things down, but they're not a death knell for the stock market. They're just another piece of the puzzle that we've seen before and survived. Now let's talk about policy and politics. The interview touches on concerns around the U.S. tax bill and what could happen if political momentum stalls. Tom's view? These are what he calls event risks. Temporary disruptions, government shutdowns, union strikes, maybe even a shakeup in Washington. They're all short-term speed bumps. In his experience, they create tactical opportunities, specifically buy the dip moments, not reasons to abandon your long-term strategy. What I found particularly nuanced was his take on bond yields and interest rates. The host brings up comments from JP Morgan CEO Jamie Dimon, who recently warned about potential cracks in the bond market. Now Tom doesn't dismiss Jamie's concerns. He respects them, especially since JP Morgan has a unique window into consumer credit data. And yes, auto loan and credit card delinquencies are ticking up. But Tom points to the high-yield market, an area known for being an early warning system. And according to him, it's holding strong. In fact, high-yield spreads have recovered 70% of their recent widening. That, to him, is a market signaling resilience, not collapse. He also gives an interesting take on the housing market. He agrees that housing is weakening, but instead of framing that as purely negative, he sees it as deflationary pressure, which could actually be good for inflation, and by extension, good for the Fed's rate policy. That's a subtle but powerful point. If housing continues to correct, it could help drive inflation lower, giving the Fed more flexibility, possibly even opening the door for rate cuts down the line. So what does all this add up to? Here's my interpretation. Tom Lee is essentially saying that we're in a classic wall of worry situation. The fundamentals are improving, earnings are coming in strong. The economy, while showing some stress, is far from breaking. Yet most investors remain stuck in a bearish mindset. And historically, when sentiment is this disconnected from price action, the upside can be explosive. That 6,600 S&P target, he's not backing off. In fact, he sounds even more confident now than he did earlier this year. So what should you do with all this? Well, this isn't financial advice, but I will say this. If you're sitting on the sidelines waiting for the perfect moment, you might want to pay attention to this setup. Markets tend to move before the narrative catches up. And Tom Lee is reminding us that the biggest rallies often start when most people least expect them. Let me know in the comments, do you agree with Tom Lee's bullish thesis? Are you still cautious? Or are you seeing signs of a bigger breakout ahead? If you got value from this breakdown, make sure to like the video, subscribe to the channel, and turn on notifications so you don't miss my next reaction and stock market deep dive. There's a lot more to come, and trust me, you'll want to be ready. Alright, the moment you've been waiting for. Drumroll please. The company that's set to redefine growth, the AI juggernaut we've been dissecting is NICE Limited. That's NICE, trading under the ticker symbol NICE. Write it down, circle it, tattoo it on your brain. Because NICE Limited is the name you'll be hearing a lot more about. This is your chance to get in on something special, something truly nice. The market? It's been a little sleepy on NICE. Their shares are currently down about 48% from their 2021 highs. Can you believe that? A company with this much firepower, this much AI innovation, trading at such a discount? It's like finding a Rolex at a garage sale. This isn't a sign of weakness, people, it's a screaming buy signal. This is the once-in-a-decade opportunity I've been talking about. NICE isn't just a stock, it's a super growth stock hiding in plain sight. We're talking about a leader, an innovator, a company that's mission critical to its clients. This isn't some flash-in-the-pan tech darling. This is a company with deep roots, a proven track record, and a future so bright you gotta wear shades. So why is it a once-in-a-decade shot? Because NICE is perfectly positioned at the confluence of AI disruption and essential business needs. This is your chance to be ahead of the curve. Don't walk, run. Let's talk about where NICE really flexes its muscles. First up, customer engagement. This is their bread and butter, making up about 75% of their sales. And folks, they are not just participating in this market, they are owning it. In a world where customer experience is king, NICE provides the crown jewels. Their solutions are all about making interactions smoother, smarter, and more efficient. Happy customers mean repeat business, and NICE makes that happen. How do they do it? With AI, of course. NICE offers end-to-end software as a service, or SaaS, solutions that are dripping with artificial intelligence. We're talking about automating customer service like never before, empowering human agents with AI co-pilots, and providing insights that businesses only dreamed of a few years ago. This isn't just about call centers anymore. It's about intelligent, omni-channel customer journeys. It's about turning every customer interaction into a win. Forrester, one of the most respected research firms out there, ranks NICE's Contact Center as a Service, or CCaaS, platform as a leader. This dominance in customer engagement is a massive pillar for NICE. It provides a huge recurring revenue stream and a platform for even more AI-driven innovation. This is a recipe for sustained growth and market leadership for years, even decades to come. Next up, let's talk about a sector that's more critical than ever: financial crime and compliance. This accounts for roughly 15% of NICE's sales, and it's an area where their AI expertise shines like a beacon in the dark. We live in a world where fraudsters are getting smarter, money laundering schemes are more complex, and regulatory scrutiny is through the roof. Who you gonna call? NICE Limited, that's who. They are the financial crime fighters. NICE provides AI-embedded tools that are like a digital Sherlock Holmes, sniffing out fraud, detecting suspicious activity, and helping institutions stay on the right side of the law. Think anti-money laundering systems that learn and adapt. Think surveillance tools that monitor transactions with pinpoint accuracy. This isn't just about saving money. It's about protecting reputations and ensuring the integrity of the financial system. And who relies on these powerful tools? Only many of the top banks in the United States and Europe. We're talking about the big kahunas, the financial giants who can't afford to mess around when it comes to security and compliance. When these institutions choose NICE, it's a massive vote of confidence. The need for sophisticated financial crime and compliance solutions is only going to grow. As digital transactions explode and criminal tactics evolve, the demand for NICE's AI-powered shield will intensify. NICE is providing the picks and shovels in this digital gold rush for security. But NICE doesn't stop there. They're also a major player in public safety and justice, a sector that makes up about 10% of their sales. This is about using technology to make our communities safer and our justice system more efficient. Think about optimizing emergency response times, managing digital evidence effectively, and ensuring that law enforcement has the tools they need to protect and serve. NICE offers sophisticated solutions that help first responders get to emergencies faster and better informed. They provide tools for managing the mountains of digital evidence, from body cams to surveillance footage, that are crucial for investigations and court proceedings. In a world awash with data, NICE helps public safety agencies make sense of it all, turning chaos into clarity and information into actionable intelligence. This is about saving lives and ensuring justice. According to IDC, another top research firm, NICE is considered a leader in this niche, right alongside giants like Axon Enterprise. Their solutions are trusted by an incredible 85% of US and Canadian cities. And get this, 94% of UK police stations rely on NICE. This involvement in public safety adds another layer of diversification and resilience to NICE's business model. By serving these critical public functions, NICE isn't just building a profitable business, they're contributing to a safer society, and that's something we can all feel good about investing in. Why NICE's valuation is a steal right now? Alright, let's talk turkey, let's talk numbers, because all this amazing technology and market leadership is fantastic. But what about the price? Is NICE a good deal? Folks, I'm telling you, it's not just a good deal, it's a potential steal. The stock is trading near a decade-low valuation, a decade low. For a company at the forefront of the AI revolution, this is where the smart investor pounces. Let's look at the price-to-free cash flow, or PFCF ratio. For NICE, it's sitting around 14. 14. Do you know what its historical average is? Around 27. That means it's trading at nearly half its typical valuation. It's like the market has put this AI champion on a clearance sale just for you. This is the kind of discount that gets my heart racing. While others are fretting over short-term whispers, we're looking at long-term shouts of growth. Buy the dip. NICE's rock-solid financials and shareholder love. A great story and a cheap valuation are fantastic. But what about the financial bedrock? Is this company built on solid ground? You bet your bottom dollar it is. NICE Limited boasts a fortress balance sheet. We're talking over $1 billion in net cash. That's right, over $1 billion in the bank after accounting for debt. That's financial muscle, baby. That's flexibility. That's the power to invest, to acquire, and to weather any storm. With a market cap sitting at $11.28 billion and an earnings per share of $6.95, this is a stock that's showing real strength under the hood. Its current price is around $177.04, but here's the kicker. It's trading nearly 68% below its fair value estimate of $297.40. That gap is hard to ignore. Now, when you look at the valuation metrics, NICE is currently trading at a price-to-earnings ratio of 25.47. That's not outrageous, especially when you consider its revenue for 2024 came in at $2.74 billion, with a net income of $442.59 million. So not only is the company growing, but it's also profitable, and strongly so. On June 5th, Zacks featured NICE as a top growth stock, spotlighting it as one to watch based on their proprietary style scores system. It's a powerful endorsement that adds weight to the growing sentiment around the stock. Just a couple of days earlier, on June 3rd, NICE was compared side-by-side with Verra Mobility Corporation in a value analysis. The results leaned in NICE's favor, particularly for investors focused on long-term value in the internet software space. That same day, reports pointed to growing bullishness from Wall Street analysts. That kind of sentiment can be a strong signal, especially when paired with improving fundamentals. And if that's not enough to turn heads, a May 21st report dove into NICE's leadership and strategy, calling out its narrow economic moat and disciplined approach across multiple business segments. While there was a slight revision in revenue expectations, analysts are already anticipating a re-acceleration in growth. That fair value estimate, again, much higher than where the stock is trading now, speaks volumes about where this stock could be headed. So here's the bottom line. NICE Limited is showing strong momentum, backed by solid financials, positive analyst sentiment, and a valuation that's hard to ignore. It's one of those stocks that's quietly positioning itself for a potential breakout, and smart investors are definitely keeping their eyes on it. NICE is a mature, profitable company that knows how to make money and manage it wisely. And what is management doing with all this financial strength? They're showing confidence in their own stock. They're actively buying back shares at the fastest rate in the company's history. Booyah! This combination of a strong net cash position and aggressive share buybacks is music to an investor's ears. This shareholder-friendly approach, backed by robust financials, is exactly what I look for in a long-term winner. Think NICE is just a local hero? Think again! This company is a global powerhouse, a true international player. Their sales span across more than 150 countries. That's incredible reach. From North America to Europe, from Asia to Latin America, NICE's solutions are in demand around the world. This isn't some niche player confined to one market. This is a company with a truly global footprint, tapping into growth opportunities wherever they arise. And who are their customers? Prepare to be impressed. NICE serves a whopping 85 of the Fortune 100 enterprises. Let that sink in. 85% of the biggest, most successful companies in the United States are relying on NICE. These are the blue chips, the industry leaders, the household names. When companies of this caliber choose NICE, it speaks volumes about the quality, reliability, and cutting-edge nature of their offerings. This incredible global presence and prestigious client base do a few crucial things. First, they validate NICE's solutions and its market leadership on a worldwide scale. Second, it provides massive diversification. They're not overly reliant on any single country or customer. This resilience is golden in today's dynamic global economy. So there you have it, folks. The case for NICE Limited as your next portfolio most valuable player. We've seen the incredible AI integration, the market dominance in critical sectors like customer engagement and financial crime, and the rock-solid financials. This isn't just a good stock, it's a potential home run, a grand slam, a game-winning touchdown. It's a once-in-a-decade opportunity staring you right in the face. Don't blink. The AI tailwinds are hurricane force behind NICE. The increasing complexity of fraud, the exponential growth in digital evidence, and the relentless pursuit of better customer experiences all play directly into NICE's strengths. Add to that an attractive valuation that's near decade lows, shares down significantly from previous highs, and a management team confidently buying back stock. The setup is simply beautiful. It's a compelling story, backed by compelling numbers. Now, the ball is in your court. You've got the information, you've got the analysis. The question is, what are you going to do with it? Are you going to let this opportunity pass you by? Or are you going to take a serious look at adding NICE Limited to your portfolio? This is your moment. Seize it! Booyah! Go get NICE! If you're enjoying these stock tips and you're ready to level up your investing skills, I've got something game-changing for you. I've just relaunched my Value Stocks Investing Master Course, designed to teach you the exact principles used by investing legends like Warren Buffett and Benjamin Graham. But this isn't just theory. You'll learn how to spot undervalued companies using real-world metrics, build a high-quality portfolio, and protect your investments, no matter what the market throws at you. Whether you're just starting out or want to sharpen your strategy, this course gives you the tools and confidence to grow real, long-term wealth. It's packed with step-by-step lessons, powerful insights, and practical strategies you won't find anywhere else. So if you're serious about investing smarter and building a future you're proud of, click the link in the description and pinned comment to join today. Trust me, your future self will thank you. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members there get full in-depth analysis on most of these stocks I mention here. Head over to patreon.com/stocksgalore and become part of our growing community of smart investors. Link is in the description. Don't forget to hit the like button, share the video, and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. Thanks for watching, and I'll see you in the next one.